Welcome to The Explainer. Let's jump right in. Today, we're tearing into a system pretty much all of us use every single day, but honestly, we rarely stop to actually think about how it works: the modern banking machine. Now, we all grew up hearing the same thing, right? That a savings account is the ultimate safe haven. It's the smart, responsible place to tuck away your hard-earned cash. But today, we're going to unpack the reality behind that assumption. We'll pull back the curtain and see exactly how banks use those deposits to build their own wealth.
Okay, let's dive into this. What if I told you that your bank absolutely loves it when your money just sits idle in a savings account? Seriously, pause and think about that for a second. Why on earth would a massive, multi-billion-dollar financial institution care if your cash is just resting there doing nothing? Well, the truth is, it isn't because they're doing you a massive favor by keeping it safe. No way. It's because your static cash is literally the fuel for their profit engine.
Section 1. The Savings Illusion, where money grows.
So, we've all been taught that a savings account is our own personal growth vehicle. You put money in, and boom, your wealth supposedly grows. But here's the uncomfortable truth. While we might get tossed a few pennies, the banks are the ones making the real money off those deposits. The whole illusion is that your money is working for you, when in reality, it is absolutely working overtime for them.
Moving on to Section 2. How banks really profit: putting money to work.
Let's track a typical deposit, say $10,000. Step 1, you deposit the money into your account. But step 2, and this is key, it certainly doesn't just sit in some dusty vault with your name etched on the front. Actually, scratch that, it's more like a revolving door. The bank immediately turns around for step 3, taking your exact cash and lending it out to finance a neighbor's house, maybe a local business taking out a commercial loan, or someone financing a brand new car. Your money doesn't sleep. It is highly active out there in the economy.
And what's your big reward for providing all that capital? Well, your savings account might pay you a meager yield of around 1%. Maybe, if you're lucky, that is just a tiny, microscopic sliver of the pie they pass back to you for the absolute privilege of using your 10 grand.
But man, the contrast is just staggering. While you get that 1%, the bank could easily be earning 6, 7%, or even way more by lending that exact same money out for mortgages, auto loans, and business credit. So your money is absolutely generating a fantastic return. It's just not generating it for you.
And this brilliantly illustrates the sheer scale of the banking business model. You've got your tiny 1% return as the depositor on one side, and the bank's massive 7% return on the other. That huge gap between the two, that's the profit spread. They are essentially renting your money for dirt cheap and leasing it out for a massive premium. It's a brilliant model for them, for sure, but it really highlights just how little your static cash is actually doing for your own financial growth.
Which brings us to Section 3. The Inflation Trap. Silent Wealth Killer.
Look, we all know inflation is that hidden economic force that quietly eats away at your purchasing power over time. Now, don't get me wrong, savings accounts are absolutely fantastic and totally necessary for liquid emergencies. You definitely need cash on hand for a rainy day. But as a strategy for building long-term wealth, it's a trap. Inflation silently erodes the true real-world value of every single dollar just sitting idle in that account.
Just jump forward a decade. Thanks to a little bit of compounding interest, your nominal account balance might actually be higher. You log in, you see a bigger number on your statement, and you think, great. But out in the real world, that money buys significantly less than it did 10 years ago. Your purchasing power has completely shrunk. You've effectively lost wealth while totally thinking you were saving it.
Let's look at Section 4, the wealthy mindset, changing everything.
So the crucial point is this: the wealthy don't ask, where can I store my money? They ask, where can my money work? That single, simple question completely changes everything about your financial trajectory. It's a massive shift from treating money as something to be hoarded away in some static vault to treating money as active capital, like soldiers that need to be deployed out into the world to earn a real return.
Which leads me to ask you directly, where do you keep most of your money right now? Seriously, based on the mechanics we've just broken down in this explainer, I want you to honestly evaluate your own financial habits. Is your hard-earned cash primarily sitting idle, working overtime for a bank, and quietly losing ground to inflation? Or is it actively out there working for you? Whether it's tied up in savings, deployed in investments, or just sitting in your everyday checking, where is the bulk of your net worth right now? Look, it is absolutely crucial to have checking for daily expenses, and you definitely need savings for a quick emergency fund. But if the vast majority of your wealth is locked up in checking or savings, you are playing by a set of rules designed to make someone else rich. If your money is constantly working, isn't it time you made absolutely sure it was working for you?
Thanks for joining me for this explainer, and I really hope this helps you rethink how your money actually works.